Welcome back. So, a few months ago, I did a video on Google. I think it was sometime in February. At the time, and let me pull that up, it was selling, let's just look at year to date. It was selling for like $89 a share whenever we did the video. And it's had a very good rise since then, okay? I think it's up, well, I don't have to think, we'll look. It's up, what is this? About 36%, okay? Now, if you remember at the time of that video, I kind of did two scenarios, one optimistic scenario and then one more realistic. So what I wanted to do was look at some recent developments like other 13Fs that have come out since that video, another quarterly result that's come out, revisit my assumptions, and then kind of do a new valuation and see, hey, is it maybe time to sell Google if you had bought in the, let's say under 90, something like that. And then in general, I think I'm just going to talk about selling winners, that sort of thing. And if you want to get a preview, it's just read that quote up top, okay? Anyway, let's get started. First thing we're going to do is look at some 13Fs. So this is dataroma.com. I'll link this. Basically, it shows you all these super investors, tracks their portfolios, their U.S. portfolio every quarter, tells you what they're buying, what they're selling, that sort of thing. It's a good tool if you're like cloning investors, or if you're just looking for that very nice confirmation bias that you bought something that a super investor bought, right? That makes it even good idea. Anyway, okay. Top 10 buys last quarter. Look at this. Google was 2 of the top 3 on top buys, and then 2 of the top 2 in top buys by percentage. Okay, so as far as the difference in classes, we're just going to treat them as equal. And I'll just show you, if you click on it, you can see individual, who added, what fund, that sort of thing. I'm not going to go into the details. Just know that it was a big buy in the quarter that ended March 31st, which meant a lot of people were buying it probably about the same time I did that video, to be honest, in February. So since then, there's also been a new quarterly result from Google, so I'm going to pull that up next. So this is Google's 10Q, and they give some notes on their Q1 financial highlights that are affecting this quarter as kind of a one-off. You can go adjust for that, but let's just take this at face value. The diluted earnings per share is $1.20. Okay, $1.23. So we'll remember that number. And then next, the other thing that you always want to check is like, they were buying back shares. Are they still doing that? That sort of thing. Okay, so to do that, the best thing to go look at is the cash flow statement. That's what I'm scrolling down to. And here's their statement of cash flows. And see, they're tricky. A lot of companies will put the recent quarter here and then the previous quarter to the right, but they do it in chronological order, which makes more sense, but it's don't be tripped up by that. All right, so it's under financing activities, repurchase of stock. They're buying back. They spent $14 billion in a 1 quarter buying back stock, okay? So up here in the calculator, we'll do 14 billion, so 14.557 billion. And then at the time, well, I'll just use their market cap right now. Okay, so let's just say a market cap of 1.5 trillion, which would be 1,500 billion multiplied by 100. You can see even at the current market cap, that's like 1% of the outstanding shares, or 1% of the market cap per quarter. Okay, and I think if you remember last video, I talked about them buying back roughly 3% per year, so that kind of fits with that. Obviously, if they're spending the same amount of cash, but the stock's going up, they're going to buy back less shares. So in a way, if you know a company's going to be repurchasing stocks, you kind of want it to stay low, right? So that your net amount goes up as they repurchase. So with that being said, let's go back up to that earnings per share number that I talked about at the beginning. Let's see. Okay, 123. Look at that. My own mistake. Got messed up by my own mistake. Okay. 123, it's actually 117. We'll just call it 120, okay? Okay, keep it simple. Let's go back, look at my previous assumptions, and we'll go from there, okay? So what I have here is what my optimistic scenario was for Google, okay? So I had full year earnings per share at 450 roughly, with a growth of 16% and a PE of 20. The growth was a little high, but I'd also done a more realistic scenario where I said 11% and a 15 PE, which I think is probably better to never go above a 15 PE whenever you're analyzing, true value of something. Oh, real quick, if you haven't seen this sheet, this is what I'm going over. So what is your starting earnings per share, how much do you expect that to grow, and then what multiple of that earnings do you expect to be able to, let's say, sell that for however many years from now. And then based on that starting price that you pay now, what's your overall return going to be? And that's what this graph is, the top one. And then what's your yearly return going to be, compounded on an annual basis, okay? So the price then was 89. So if I put 123 here, what happens is that all this really starts to shift down, right? I mean, you're looking in this kind of, let's say, pessimistic scenario where earnings are starting at 450, only growing at a little over double digits, and then it'll never get past a PE of 15. What you're seeing is that your overall return is still, it's not negative, right? But you really don't, I mean, even if you held it for 10 years, you'd only get 5% compounded at the time with these conservative assumptions, okay? So instead, what I want to do is look, let's try to do an optimistic scenario. And this brings me kind of to my point about selling winners. One thing I really like to do is if you have something that you're up on, to buy it, you use the margin of safety and conservative assumptions, right? So you had very conservative assumptions and you applied a margin of safety. I think to sell something, you need to apply liberal assumptions, or let's say optimistic assumptions, and then have a kind of a reverse margin of safety on the upside, so maybe like 20-30% above your high-end valuation, okay? So anyway, what was that, $1.20 times 4, so 480. Hell, let's just say 5. Let's say they start at 5. They're going to grow, let's say at the growth rate is so, be very careful picking a high growth rate because it really affects your valuations. But let's say that they're going to grow it at 15%, okay? And then their PE is going to be 20, whenever you go to sell them. All right, so in this scenario, you're looking at, after 5 years, about a 10% compounded return. And then if you hold for 10 years, about a 13% compounded return. So, I mean, at a discount rate of 15%, I would say that puts fair value probably around 115-ish. Let's see, no, lower than that, 110. 107. Close. Okay. So, if you don't know what I did, basically I just tried to backwards calculate what starting price gives me a yearly return at 15%, which is kind of like, you see how this kind of runs into the 15% asymptote. But anyway, what I'm trying to say is that I think fair value is somewhere probably between 100 and 110 with optimistic assumptions. And then, let's use that 107, and you multiply that by, let's say, 1.3 as like your reverse margin of safety. I think 140 seems reasonable to sell. You can also look at adjusting for taxes. I have a whole video on that about how you should view taxes whenever you are selling a stock, because it really should go into your decision to sell. Because if you're up 50% on a stock, and let's say you're up 50%. So you're up 50% and you're in a 20% tax bracket. That means that the stock is immediately going to take a 10% hit whenever you sell it, right? So if you sell it for, let's say, 150, then you're going to immediately be taking a $15 hit per share on that, okay, that sort of thing. But that's just my opinion. Like I said, some people, probably Warren Buffett now, Peter Lynch, Phil Fisher, those types would, and Monish Pabrai, same thing, Charlie Munger, would all probably disagree about ever selling a stock. That if you bought the right stock, you want to hold it forever. But I do think that there is a price, especially if you're dealing with a small sum of money and that you have other opportunities that might be better for that money. There's times whenever you should, rebalance the portfolio, right? That's just my opinion. That's kind of how I look at it. I hope you enjoyed the video. Like, subscribe. I'll see you next time.